Hey everyone, Coach Investor back to another video for today. In this video, we're going to go over Roku's earnings report. At the time of making this video, stock is up 10%. Why is that? They beat on the top and bottom line, and their outlook was also better than the consensus. Now, before we go into that, I just want to thank the two new members of this channel, Daniel White and Ghazi Andari. Thank you very much for supporting me. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and if you want to support me even further, you can check out the links down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now, with Roku, obviously during the day, it also got a huge boost. Maybe that's because, well, the trade desk showed that even in the current market environment, you can perform quite well, seeing that Roku and the trade desk are playing a little bit in the same market, of course, the advertising market that is. Now, despite all of that, despite weakness in ad spending, the stock market has seen some positives here and there. Now, I'm going to go over the report, show you the positives, but also the negatives, of course. Since the lows, Roku is up a tremendous amount. I don't know exactly how much, but we went from 40 to right now after hour 70. So that's a huge increase. Of course, that does not mean that we should be having victory laps already right now. One good quarter, one okay quarter, let's say, does not mean that we're out of the woods just yet. So let's have a look at the numbers. I'll first start with what they're expecting when it comes to expenses. So we plan to continue to improve our operating expense profile to better manage through the challenging macro environment while building on our platform's monetization and engagement tools and partnerships. You will see why this is important later on. We are committed to a path to deliver positive adjusted EBITDA for full year 2024. So we still have time for that. Now, when it comes to the 2022 results, they increased net revenue by 13% year over year to $3.1 billion. Platform revenue increased 20% year over year to $2.7 billion. Gross profit was just up 2% year over year to $1.4 billion. Of course, we know that gross profit has been taking a hit heavily during the downturn. Now, active accounts reached 70 million, a net increase of 9.9 million active accounts from 2021. Streaming hours increased by 14.3 billion hours year over year to 87.4 billion. ARPU grew to $41.68 in the trailing 12 months. That's up 2%. But as you will see, quarter over quarter, it's actually down. And in Q4, the Roku channel reached US households with an estimated 100 million people. So, okay, all good and well. Well, as good as it gets, as they say. Now, when we look at ARPU, let's say quarter over quarter, you can clearly see Q3 to Q4, it's down. Why is it down? Well, because currently the market for advertising is not having the greatest time. We're going to talk about this a bit later on. But the other two metrics here, streaming hours and active accounts, that has grown pretty okay in my eyes from Q3 to Q4, year over year as well. So I'm liking those numbers. Now, when it comes to platform revenue and devices revenue, by the way, they changed the name. This was previously player revenue, which now makes a bit more sense with all the devices that they have. So platform revenue grew 5%, devices revenue decreased 18%. We know why. This has been the story for the last couple of quarters already. Now, when it comes to gross profit, same story there. There is an increase quarter over quarter. Of course, Q4 is usually the strongest quarter for the company, but still, this is down 4% year over year when it comes to platform. When it comes to devices, gross profit, well, basically flat. Then, of course, if we continue, gross margin, same story there. For the platform revenue, it's still above 55%, but quarter over quarter, we haven't really moved much. Year over year, we're actually down 4.8 percentage points. When you look at devices gross margin, that's down 5.7 percentage points. And, well, not that better quarter over quarter. Now, we do know that they rather take the hit themselves than maybe increase the prices, so consumers will have to pay more for their devices. Maybe that's also why you can see that active accounts have increased quite nicely. They rather attract more and more people to their platform, let's say, and then monetize them much better when the ad market returns to its former glory, which again makes sense. But then when it comes to operating expenses, and this is why, well, getting costs under control is extremely important. We can see here huge increases. Total operating expenses, it's up 71% year over year. Now, when you look at income loss from operation, there's no really meaning behind looking at these numbers, just not great. Adjusted EBITDA is also down 210% year over year. Adjusted EBITDA margin, also we went from up 10% to now down 11%. So that's the story currently. Now, in regards to the outlook, so consensus was around $688 million for net revenue. They expect $700 million, total gross profit of $310 million, net income loss of $205 million, and adjusted EBITDA, a loss here as well, $110 million. Now, of course, you have to include here stock-based compensation of approximately $110 million. We're going to have a look at stock-based compensation later in this video as well. Now, in the grand scheme of things, if we look over the last couple of years, yes, every metric has increased on a, let's say, 4-year CAGR basis. Of course, during the pandemic, everything here got pulled forward, and now in a downturn in a high inflationary market, of course, everything is slowing down. But if you look at the last 4 years, the company has grown quite nicely. If you look at the stock, well, maybe right now, since we're back at $70, it has maybe moved a little bit, but back when we were $40, to me, didn't really make that much sense. That doesn't mean that you should have added, no, because the company was not in a great position anyways. Now, for those that need a quick reminder of what the business model actually is, the cycle here, the flywheel, so it's basically grow scale, grow engagement, grow monetization, and then repeat that over and over. Pretty simple, actually. Now, a couple of statements that they made here. So Roku is the clear leader in the world of cord cutting and is almost twice as popular as its next competitor. Okay, pretty big statement. Then, when it comes to Roku TV, in Q4, Roku TV gained share, and we extended our leadership in the United States, Canada, and Mexico. According to NPD, the Roku operating system was the #1 selling TV OS, well, smart TV OS in the United States, and our 38% share of units sold in Q4 was more than the next 2 largest TV operating systems combined. The Roku OS was also the #1 selling smart TV OS in Canada and the #1 in Mexico, where we grew to 30% of units sold. So this again is great to hear. Then when it comes to their own Roku smart TV, so own Roku branded TV, those will be available in the US in spring of 2023. Now, when it comes to their smart home devices, they say here, similar to our TV streaming model, we plan to build scale with our devices, then monetize through smart home devices, which we expect to become a very large market. Of course, this goes into the segment of devices, so don't expect gross profit to be, well, extremely big. And then the Roku channel is basically the free channel that they offer, but this is ad supported. So in Q4, it was a top 5 channel, as per usual, on the Roku platform by active accounts reach and streaming hour engagement. We grew engagement over 85% year over year, and it reached US households with an estimated 100 million people, positioning us strongly when the ad market rebounds. Again, this reinforces my point I made earlier. Right now, get this to as many people as you can, and then when the ad market comes back, you just have to monetize it correctly. And now going back to what I said before when it comes to ARPU, why is it down quarter over quarter? Why is it so weak? So they basically say here, inflation and macroeconomic uncertainty continue to pressure consumer and advertisers in Q4. The total US ad market weakened throughout the quarter, declining 12% year over year in December after decreases of 2% and 6% in October and November respectively. So clearly this is not just a Roku issue, but of course we've seen other companies perform a bit better, but just the overall market right now, especially the market they're positioned in and their target, let's say, is not doing great. So that might explain, or that is explaining the weakness in ARPU. And then last couple of things, when it comes to operating expenses, as we've seen before, it was extremely high. So they say here they expect operating expense year over year growth to significantly decline over the course of the year from approximately 40% in Q1, a 30-point sequential improvement from Q4 2022, to single digits year over year growth by Q4 2023. Okay, this is great because currently if this continues, well, this becomes not really sustainable. Now, if we drop down even further, scroll down all the way to stock-based compensation. You can clearly see here, right? This is for the quarter ending, went from 54 million last year to 104 million this year. For the full year, we can clearly see again a huge increase there. This can just not continue currently. And so to conclude, while again the market might react positively to this report, again there's still the earnings call. Let's see what they mention there. If there's something extraordinary, I'll pin it in the comments down below. But just because the stock is up, just because this was maybe a better quarter than feared, does not mean that you suddenly have to go all in the stock right now. Also, it's up a lot since the bottom. Maybe there has been some anticipation already baked into the price right now. Again, remains to be seen right now. The positioning of the company is good in the market that they're playing in. But the financials are not that great. Let's see if they can, well, execute on their promises throughout 2023. Certainly right now, things are getting a bit better than the last couple of quarters. And that's why I am happy to sit on my hands currently. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Stay tuned for the Shopify video, and I'll see you all in the next one. Bye-bye.